Great. Well, the objective you've gained is really using a value-based lens to not just manage your brand and your technology IP, but also your innovation initiatives. And Alice in Wonderland might seem a fairly odd reference point to this, but the need for identifying the destination and the path, I think, is really made by this little quote. Now, all of the organizations that we work for, I think, will have pretty clearly defined corporate objectives and will normally have quite well-defined pathways for achieving those. But quite often those pathways don't filter down to the level of brand or technology or innovation management. And quite often when it is determining a level of investment for a particular project, value is the primary objective. But there are many instances in many organizations where value has to be defined a little creatively. I did work for the World Heritage Convention some years ago and had to spend some time working out exactly what we meant by value creation, and there it was maximizing their capability to protect sites of outstanding universal heritage. But I think most of us are in a kind of more mainstream corporate objective where if we are valuing a business unit or a particular project, the executive team certainly will be interested in the future cash flows, the risk associated with that, and often getting the net present value of that particular project. And if we do assume that value is the objective, it's worth thinking about the pathway to creating value. So there we say value is the present value of future cash flows. There are only a handful of drivers of those cash flows. So, top level, we've got the demand, which has been spoken about quite a lot today. Obviously, the price that one's placing on particular products, but there's also the efficiency and risk element. If we go a step back, demand can be disaggregated into number of customers and revenue per customer, and even a step back, if we're looking at where is that next dollar coming from, is it through acquisition of new customers? Is it retention of existing customers? Is it selling more of the same? Is it, as with the Cabots, increasing the frequency of acquisition, the good old McDonald's upsell, cross-sell? But quite often in innovation, we're also looking at the efficiency side of things. Can we reduce the processing costs? Can we increase marketing efficiencies? Now, obviously, in any planning process, one has to be pretty clear if you're looking for an extra dollar, where is that dollar coming from? Because clearly your strategy and tactics are going to differ substantially depending on which one of these levers we're looking at. Now, Phil, in answer to your question about portion of value coming through from intangibles, most intangible assets, or most IP, doesn't end up on the balance sheet. So you do have this big gap where if you look at the market capitalization of a company and compare it to its balance sheet assets, there's an enormous gap which just isn't explained. But when there are corporate transactions, companies have to actually identify the assets they've bought and put a value on them. So here are two very different examples. When Google acquired Motorola, $12 billion US, over 40% of that was attributed to technology and patents. More of a brand-centric market, when Kraft acquired Cadbury's, 41% of the value was attributed to brands and the intellectual property associated with brands. Similar ratio when SAB Miller acquired Foster's. Now, the reason I've touched on this is because they're showing, if we've looked at the value of a business or a business unit, this is starting to show the assets or the building blocks which are generating that value. And that straight away leads to the conclusion or the thought as to how can we exploit those assets better to spit out that extra dollar of cash flow. So this is just very broadly looking at a Cadbury's type company. So on the right-hand side, we've got those good old drivers of cash flows, but then under the asset category, we're looking at the different assets or resources within the company, and the bubbles are trying to represent their relative importance. So we're saying, yes, in this particular business, brand is very important. The other aspect that this value map recognizes is this isn't a straight, simple, linear process. You might, through improving staff engagement, improve customer service, and increase brand strength. Or you might come up with a great invention and capture that reputation for innovation in your brand. So they're quite complex relationships between those. An aspect which I find very useful, an engineering concept of systems dynamic modeling, where you think of these assets as stocks, basically. So if we're thinking of all the product-related IP, what's making your product superior to alternative products, there is a kind of stock level. And through innovation, for instance, you can increase that. If you don't increase it, there's a kind of natural decay, either because customer needs change or competitors come up with something different. But building up product IP or building up brand equity isn't a means to itself. It's only the extent to which we know that a stronger asset or a greater stock of that particular asset is also going to impact on demand or efficiency and improve the value of your business. And once again, it's this concept of understanding those linkages. So yes, the more of our product differentiation we might have, as long as we communicate that effectively to our consumers, we can also have a stronger brand, which might in fact outlive that product differentiation. So yes, that bucket IP might keep on giving from a branding perspective. However, that perspective we've been looking at now is very kind of internally focused. It's almost kidding yourself that your own assets are the only thing that's driving customer behavior and cash flows. Obviously, you've got the old macroeconomic environment, you've got actual consumers, consumer needs, market perspectives, what's going on in terms of competitor offers, and very importantly, who's inventing what and where could the disruption come from. And we also find it's very useful getting to understand what's happening in the transaction space, be it licenses, sales of IP, or in fact litigation. So I won't delve into these because most of them in isolation are kind of same old, same old. There are lots of really great marketing tools and so on, which are, or consumer research to identify needs and so on. But what we're trying to say is each one of these landscapes might have particular insights, but it's when you join them up and when you understand how they impact on demand and efficiency and cash flows that they become particularly important. So, you know, something like Porter's 5 Forces model has been around for a long time, but on the top left, if one also starting to understand, well, the way we've defined our market in the past might actually not be appropriate for the future because there is some sort of disruption or some sort of merging of what had been traditional markets. And the tech landscape, for those of you who come to a lot of Hargrave's events, you'll probably have met George and Lynn from Griffith Hack, and they focus in on the IP landscapes and enormously useful insights in terms of understanding, firstly, what are the trends in terms of patent registrations in different markets? Where are those coming from, or in what jurisdictions in a particular industry are patents being filed? Also, kind of who's really active. And the greatest insights from kind of patent landscape analysis is starting to understand the links between different inventions. It's almost like in a LinkedIn network when you start understanding who's really important in a network, not just they've got more followers, but they have the really important followers. So one's able to gauge the strength of particular inventions, and obviously that can have huge insights to future performance and future value. Again, we also have access to databases and so on for licensing agreements, royalty rates, transactions, litigation, and so on, which gives another kind of deal-making perspective of who's interested in what's happening in those markets. But again, the point I want to stress is it's the integration of those. So this little pyramid at the bottom, we've got the corporate strategy, but it's through combining those insights from each one of those different landscapes, and most importantly, kind of integrating them into a coherent economic model where you are starting to say, all right, this is the market we think we're happening, this is the trends or the change, the level of competition. This is why our product, our particular product offer is superior to the competitors, and this is how it's going to translate into that economic model in terms of increasing the rate of acquisition or in terms of increasing the efficiency of your supply chain. So ultimately, when one gets through to expressing the expected economic impact of something, we wouldn't for a minute pretend that's right, because no one has the crystal ball and things change and there are many layers of assumptions built into a valuation model, but it's being able to kind of calibrate and integrate those different landscapes and those different value drivers, and quite often that process is almost more valuable than the output itself. And ultimately, you know, in the innovation space, it's really understanding, okay, we've identified the current importance of our different assets within the business. What are we going to do, or where is the next dollar best spent? Is it through focusing in on our manufacturing IP or our product IP or our brand IP? How can we increase the value of those assets and increase the value of that business or that business unit? Another point worth making is, you know, at different points, whether it's the planning, whether it's the progressing or tracking the execution of that, or ultimately an annual review. Are you on target? Have the markets changed in a different way? Is there something new? How do we have to react to that? So that kind of 360-degree perspective, or that dashboard, which will be integrating all of these insights, we'd say is something that should be tracked at each one of those stages. Conscious that we're getting close to tea time, but just a couple of little snapshots of how that can be employed. So this goes back years ago when I was advising Allied Domecq, who owned the Courvoisier brand, which at that stage, it was the about late 90s, where cognac category was in decay. And if you look on the left-hand side of this, this is just a split of the cognac category in different regions. Overall, it was in decline, massive decline in Asia, little bit of growth in the Americas. But if you looked at Courvoisier, and they were very internally perspective, it was just declining in every single market. It's only once one started trawling through competitive data and various other things that you saw, in fact, Hennessy was growing at a pretty massive rate in the Americas. If one overlaid that, then segmenting the market by different qualities of Courvoisier, the VS, the VSOP, and the other, again, the category as a whole wasn't doing particularly well, and Courvoisier was doing dismally. But once again, Hennessy was achieving quite a lot of growth in the lower end, and it turned out that the whole occasions of drinking cognac were changing, particularly amongst Afro-Americans, where it was becoming an everyday drink with a mixer. But Courvoisier just wasn't appropriately packaged, presented to that particular market. So the little spreadsheet insight there provided the insight to obviously a whole lot of creative work and brand positioning work. What went to the executive team was, we can carry on doing what we are doing. We can do the initial strategy they had in mind, which was reducing the level of investment in the brand, but due to the cost impact, that was actually going to destroy value, or they could go through this brand repositioning exercise. Within a year, it had achieved a 2% return on capital investment. It was one of the fastest growing spirits brand internationally. So again, that was integrating the insight, using it in the spreadsheet model, but obviously the creativity had to bring it to life. A very different study with a research organization where they were preoccupied with their patents. It turned out they had much broader capabilities than just their patents. What was insightful for them was jumping to the far end of the spectrum and saying, the markets they were involved in, the technology would only kind of be ready for market in about a decade. But it turned out once we started looking at the applications for this technology, there were kind of spin-off markets. Once we'd identified how that would be used, what the user requirements were, it obviously identified a gap between what they were inventing and what the market would ultimately require, and that had pretty profound impacts on all sorts of aspects of the organization's IP management. And that integrated a whole range of different insights. I won't delve too much in the tech landscapes, but really through understanding who's inventing what, who's registering patents where, can be hugely useful in identifying emerging threats, who's trying to eat your lunch. We've had clients where, fortunately, they'll identify the emergent technology owned by a smaller player, and they can acquire it before it becomes a threat. You also get the tech arbitrage opportunities where you find a great invention, but someone's only registered a patent in one or two jurisdictions, and you can obviously use that in others. So really good frozen froth on beer story, if anyone wants to hear that at tea. But again, from managing your patent portfolio, working out how you can beef up the portfolio, who could be interested in licensing it, again, absolutely crucial. So the examples were pretty quickly run through, but I think the key recommendations is by improving the visibility of these landscapes, but more importantly almost, is integrating the insights from the different landscapes can really help you identify important opportunities or good reasons that the status quo isn't going to be any good in the future. Also, that understanding of valuing and understanding the relative importance or the stock of these different resources that you have. How can you hope to manage the risk or develop an appropriate strategy if you don't know what you've got now in terms of your assets? And obviously that understanding or integration of that into scenario models, yes, you might not be able to get a precise model for what, a precise number for what's happening in the future, but understanding the relativity or the important assumptions within that can be important. And once again, we'd say that's not just the sort of thing that you can pull out every year or so. Some of those measures you have to track pretty regularly. So the whole purpose of that, again, getting back to the destination, is increasing the bang for your buck in terms of innovation, technology, or brand investment. So that was super quick, but hopefully it'll allow you to have a cup of tea before the final sessions.
Thank you, Tim. I guess just a preliminary question, a quick one. In terms of who's actively looking at IP trends and patents and what's going on there and using that data, what does that landscape look like? How many large organisations would be coming to you and saying, let's check this out and get some value from it?
It tends to be organisations who regard themselves as being in a more tech-centric market. But what one often works out is those who don't regard themselves as being in a tech-centric market might be blissfully ignorant, I guess. So look, there is an increasing focus on that, but amongst Australian companies, it's still the minority who really are understanding the technology landscapes within which they operate.
Great, thanks. Now, does someone have a question for Tim before we do get our break? Yes, please.
I'm not attending from Food Minds. I would be interested to understand what are the leading motivators for people to have basically patent filed today. What are the top three intentions people do or companies do when it comes to filing a patent or basically protecting their IP in the classical sense as we do in the past?
Well, I guess that the classic, would be to create the monopoly of use over that patent in the particular markets that they want to, stop someone else, particularly in those where there's been enormous research and development around that patent. But there can be very different applications. So some might have defensive patents, some might have a patent with a view to being able to generate licensing revenue. So there are a multitude of different reasons. We wouldn't say a patent's the right protection for every single invention or every single product, but it's certainly something that can give you very substantial cash flow benefits, both in the business as normal and in kind of leveraging that asset through licenses and transactions. Was that?
Yeah, but the problem is I'm asked by a lot of startup companies, is it right for me to put a patent in, or should I spend $50,000 actually to patent my invention? And I usually tell them, no, don't do it. Spend the money on getting your product out. Because, you know, if you get sued by Microsoft or Apple or whatever, or you patent, you lose any litigation anyhow, because you don't have the money to fight in court. So what is the point of protecting that if you're a startup company?
So I guess there are quite a few aspects to that. The one is you don't have to spend huge amounts of monies right up front. When you get the provisional patent, you're almost getting a period of grace before you have to file patents in all sorts of different markets. The other thing, whether it's through litigation insurance, whether it's through joint ventures with other partners, you can get ways which are more cost effective for a small company to protect it. Because I agree, if you have a patent and you're not prepared to enforce it, it's of little value unless you on-sell it to someone else. So there are a whole lot of factors that have to be considered as to whether that's the right type of protection. But at the same time, you know, I just did advice for a company entering into a license in a particular market, and it turned out they'd not maintain the patent in that particular market. So the royalty that they could get was much lower. They just had a bit of adjacent confidential information. So there they'd made the trade-off, they hadn't registered it, and in the long run that kind of caused a problem.
Great, thanks. Now you can ask Tim any extra questions in the break. Here's a small gift from Hargraves. Thanks very much. Cheers.